of investing. Before I start this video, I would like to just acknowledge that I won't be recommending any investments, nor will I say that you're going to do certain stuff. I'll just go into this video. As you know, when I do part 1, it's a very general introduction to investing, what it is. I mean, on later videos, I'm probably going to go through your alpha, beta coefficient, expected return on assets, and etc. But for this video, I'm just going to go through very basic, and I won't recommend ever in my videos that you should invest in something. But make sure when you invest that you always invest money that you can afford to lose. It's very important that you remember that, because you should not invest money that you can't afford to lose, because if you do so, when you invest, there is a possibility that your investment goes to zero, which means that you lose your money. With that being said, let's look at a normal screen, which you will see if you are beginning. So this is a print screen from Avanza, which is a Swedish broker, you know. And at first, as everyone knows, it's graphs, as you can see right here. So this line represents the OMX 30, which is an average of a couple of large companies in Sweden, which is compared to the actual graph. So this graph represents the prices when it has closed every time, right? So as you can see here, if you would like to buy a stock, for example, an Elos Vind, I'm not saying that you should or you shouldn't. It's up to you to do it if you want. I have no part in that, so don't come back and be angry at me, you know. But we have a shop here, and I apologize that it's not in English, but shop means buy, and sell means sell. Yeah, I apologize for that. And yeah, you probably figured it out. But here we have people who wants to buy stocks in this particular company, right? And here on the other side, we have people who wants to sell stocks. So these people already have stocks in the company and they would like to sell. These people would like to invest. Yeah? When people like these two wants to when they have to come to an arrangement that they want to sell at a certain price or buy at a certain price, they come down here. And here you can see that Avanza, we had a buyer that bought 2 stocks, and JP Morgan sold 2 stocks, yeah, at a price of 195.65 crowns. Yeah, this resulted into this graph movement. So whatever happens here results in the graph's movement. And when you do investments or when you do investings, it's very essential to look at all information that you can. So you have the average, and you have a lot of more different things, but I won't go into this today in this video. I'll go into it in a later video, as I explained at the beginning. But it's essential to remember the most basic thing when it comes to investments, which is buy low and sell high. Yeah? So if you buy low and you sell high, you'll make a profit. So for example, here's AstraZeneca. And as we can see, on Thursday, the 24th of June, the price was 985.9. Right? The current price for AstraZeneca today, we can see it right here. It's 145.40, right? So what you need to do, let's say that you bought 1 stock here for 985 crowns. Yeah, 1 stock for 985 crowns, right? Then you take the difference between these ones 0.4 minus 985. This is just one way how you can calculate your profit. Yeah, and if you take that into your calculator and you calculate, you'll probably get something about 60 crowns. 60 crowns, right? So then you take this sum, or this thing right here, times how many stocks you have. You had 1 stocks, and that will give you how much crowns you have earned from your investment. So if you bought 1 stock at the Thursday, the 24th at 10 o'clock, you will now have earned 60 crowns. But if let's say that you bought 2 stocks, yeah, and the current price exactly like it is, then you would earn 2 times 60, yeah, which is 120 crowns. Yeah, but let's say you bought, let's say you bought 500 shares or stocks, whatever you're from, then you should have to time it by 60. So if you take this and times it, you'll get 30,000 crowns. Yeah, pretty simple. So if you bought 500 shares right here, and you could sell 500 shares for the price of 445.40, you would make 30,000 crowns. Yeah, and we bought low. This is considered to be low if you look at this graph right here in a month, and we sold it high, right? So what happened is that you want to buy as low as possible, and you want to sell as high as possible. And as you can see in the graph right here, it has gone down a little bit, right? You could sell it at, I think this is 147 or something. So you could actually sell it at 1,047, you know? So the best possible outcome for you would be to sell it right there. But it went down because someone sold it from here, and it went down a little bit, and the current price you could sell it for was 500. So if you would list your 500, this one would be 837. So you would be a part of these sales right here. And then you need a buyer to buy your 500 shares. So if it would be, the transaction would occur, this one, instead of it saying 552, it would say 1,552. Yeah? And then when you meet in the middle, you should say you are from Avanza, let's say. Avanza. They bought from Avanza, and you're from, let's say, I don't know, JP Morgan or something. JP Morgan, yeah? And this would be 500. And that's the most basic form of investments that I can give you. Yeah? Let's look at something else. So here you can see on a 5-year basis, I'm sorry, it says år is in Swedish, this is years. So on a 5-year basis, if you would buy stocks in AstraZeneca 5 years ago, you would earn 104.38% on your investment. So if you invested X amount of money, you would earn 104.38%. Yeah? Hope that makes sense. With that being said, as I said at the beginning, when you do investing, as general as possible, you want to have as much information as you possible can to ensure that you will sell at a higher price than you bought it for. Yeah? And therefore, we are not going to consider this normal graph that we are normal to. So we have to introduce something called candlesticks. Candlesticks is the motion by using different colors to graphically express the size of price movements. Yeah? price movements is the keyword here. Traders use candlesticks to make a trading decision based on patterns that appear on a regular basis and help foretell the price's short-term direction. Yeah. So if we look here at Apple, for example, we can see here a lot of different candlesticks. So if you would look at these, for example, as here you can see at this candlestick right here, you can see that the open price, which is written right here, was right over here. Then we had the information that it went all the way down here before it closed. And then when it closed, it went up over here and then fell down all the way down here. But when this one closed, it went up again and it went up and down, yeah? So the candlestick shows you the open price, the close price, the highest price, and the lowest price. And you don't need to be a scientist or a brain surgeon to understand that if the wick or the shadow is taller on this particular bit, then it means that the sellers are in the majority. And if the shadow are dominating on this particular side up here, you can see that the buyers are in the majority. And it's based on this right here. So here you can see that the sellers are dominating the buyers, which means that it goes down, right? Here you can see that the buyers are dominating the sellers by looking at show it goes up, yeah? So what we have to consider here now, because we want to buy as low as possible and sell as high as possible. So right here at this open, let me see where I hold. So here is the open price, highest, lowest, volume, and change. But let's go into this in another video. Let's just consider on the, here we go. So a high, open, high, low, close. So right here we have the information we need. So the lowest was at 144.42 and the highest was at 144.61. It's a very, very small candlestick right there, as you can see. So if you would buy, let's potentially say that you would buy at one stock, yeah, one stock at 144.42, yeah, you would buy one stock and then you would sell one stock at the highest amount, which was 144.61. Then what you need to do is that you need to take the difference like we did on the previous slide, and then you have to times it by how many shares you have. So you have 61 here minus 42, which is 19, which means that you have one stock times 0.19. This is how much money you would make. So you would make 19 cents. So if you would buy at the beginning of this particular candle and you will sell it right here, you would make 19 cents, right? But let's say that what's the current price? It's 145.68 is the closing price for this graph. Obviously, I mean it's probably something else now. It's just a copy paste, but this is July 13th, yeah. But let's look at it. So if you would buy at the lowest price, 144.42, let's say you bought 500 shares, yeah. So this would be the cost of your investment. So you take 500 times 144.42, which is $72,000, yeah. So you would invest $72,000 right here, And let's say that you will hold it until, let's say you sold it at 170 right here, somewhere here, yeah? Then you take the difference, then you take 147 minus 147 minus 144.42, which will give you approximately $2.58. Yeah, and you times that by how many shares you have. Yeah, and that will give you a profit. Times, remove this part. So that will give you that from your investment you bought right over here and you sold right here, will make you $1,290. Yeah, that is the basic thing how it works. And and now when we have the graph in front of us, we can see, oh, it was a good purchase because we bought it and we sold it up here. That's pretty good. But the tricky thing when you're investing is that you don't know, or you can, okay, let's not say you don't know, but you are unsure about predicting the future, whether the stock is going to go up or down, and how you going to make sure how to make sure that if it goes up or down. I'm going to explain in later videos. You can't, I will say this right now, you can't know for 100%, you can't be 100% sure that it's going in one way or another, you know. It has to do with efficient market hypothesis, and that hypothesis I'm going to discuss in a later video. But for now, we see that the graph goes up, it's increasing upwards, and we sold it at 147. I don't know how many minutes these are, but if you know what day trading is, you know that day traders make a lot of money really quick. Yep. So if you bought it at 144, if you invested $72,210 right here, and you sold it at 147, you would make $1,290. Yeah. And in order for an investor to have a higher expected return, an investor need to accept a higher risk. Just keep that in mind. And that was it for this part 1 of introduction of investments. I really hope that you got a basic understanding. It's a lot of